Hey everybody, what's up? I'll tell you what's not up is the stock market. That's because the stock market correction, the long overdue stock market correction, has begun. And most people do not understand the reason behind this. It did not begin today, it did not begin last week. In fact, it began 2 months ago when the Fed announced at its September 19th FOMC meeting that it was going to begin reducing the size of its balance sheet in October. And for most of October, we did not really see any sign of a decrease in the Fed's balance sheet. However, in the last week, if you look at the weekly H.4.1, which is the factors affecting reserve balances report that comes out every week that the Fed puts out, basically a snapshot of the Fed's balance sheet, we saw a very significant, at least relatively significant, decline in the Fed's holdings of U.S. Treasury securities. All right. Now, my contention, what I have been saying, is that some of the more clever, if you want to call them that, zombies, have been waiting and anticipating for this to happen. And I say that, of course, clever. I'm being sarcastic. They're selling based on a rationale that is a flawed rationale. Okay, and I'll get into that in a second. But it is their belief, and basically a universally held belief, that balance sheet reduction equates to taking away the punch bowl, right? Removal of stimulus. I've been over this many, many times when, in fact, what's interesting is that balance sheet reduction is exactly the opposite. It is filling up the punch bowl. All right, that's actually what all of these nut jobs like Peter Schiff and Mark Haber and Jim Rogers and all these other guys, they're printing money. That's what they all got wrong back in 2008 and onwards, when the Fed started to engage in all of its extraordinary monetary operations, zero interest rate, the zero interest rate, asset purchases, quantitative easing, etc. All that was not inflationary or hyperinflationary as they thought. See, none of these guys understand monetary policy. None of these guys understand monetary operations of the central bank. They don't understand. Basically, they don't understand the monetary system, all right? In their minds, they're kind of still on a gold standard. But under those operations that the Fed and currently other central banks are still doing, like the ECB and the Bank of Japan, those are deflationary. I mean, they remove income from the economy. And they also set prices lower by virtue of the fact that when you set interest rates at zero, that is setting a general price level. All the cost of all goods and services, or I should say the cost of credit, is reflected in the cost of all goods and services. So you put credit very, very cheap. You put the price of credit very, very cheap at zero. And that trickles through to basically everything in the economy. The central bank is a price setter that acts on behalf of the government in the interest of the government. At least it believes that, but it is a price setter. And it is a monopolist in that regard. So they got it all wrong that way, and they're getting it all wrong now. Because rather than and here is like the kind of crazy charade that went on, right? That when the Fed ramped up its balance sheet to $4.5 trillion, most of that being Treasury securities and mortgage-backed securities, the Treasury was paying interest to the Fed, which the Fed then turned around and gave back to the Treasury. So there was this crazy, ridiculous kind of charade going on where the government was creating money, giving it to another branch of the government, which then turned around and gave it back to the original branch of the government. And we all run around screaming about how, the debt, the national debt. In essence, the Fed could have just ripped up those securities, because that's exactly essentially what had happened, right? The securities were taken away. They were owned by a part of the government, the Fed, which one other part of the government, the Treasury, paid the Fed the interest, and then the Fed gave it back. I mean, how stupid is that? And you know, we should just come out and say, this is a ridiculous, idiotic charade. However, we don't say that. But now what's happening is those securities, the Fed, as a result of standing back and not only not purchasing those securities anymore, but now unloading some of them or allowing them to remain in the economy, that income now flows to the economy as opposed to flowing to the Fed and back to the Treasury. So the income flows to the economy without necessarily an increase in economic output. So this is literally money printing. This is a fiscal expansion on top of a fiscal expansion that is already happening because federal government spending is on track to make an all-time record high this fiscal year. All right, and that's even without the tax cuts if we get any. By the way, just as I should mention on the side, that a lot of people think this market sell-off is based on maybe some stumbling blocks with regard to the tax cuts. No, it has nothing to do with it. Nothing to do with it. And even if we do get a little rally, if the tax cuts pass, you sell that rally. What is happening here, and you can go back and trace it very clearly, is a liquidation is beginning, which can be traced back to September 19th exactly, where institutional asset managers who were the principal buyers in this entire rally over the last year, principal buyers of the stock market, have begun to unload their positions. And you could see that in the numbers. And that is just getting started, all right? That is just getting started. Now, it's not even as simple as that. If it was, then we could say, oh, you know, it's a correction that might last for a short period of time, and then everything's going to be fine once those asset managers have pared down their long positions or maybe even gotten short. Who knows? No, it's not even that's not even close to being the end. Because even if the Fed doesn't raise interest rates, which I consider that to be a low probability, because as I alluded to, or as I mentioned earlier, the unwinding of the balance sheet is actually inflationary. So we are going to see inflation tick up. We'll see it. I've been saying this. I'm the only person saying this and giving you the rationale and the reason for it. So we're going to see inflation pick up. We saw it in the PPI, CPI, core CPI now running above 2%. All right, Fed's target is 2%. But as the Fed continues to unwind its balance sheet, and don't forget, they're doing this incrementally now at only $10 billion a month. It's nothing on a $4.5 trillion, but they're going to ramp this up to $50 billion a month. And right now, only very few of these zombies are seeing what I'm seeing, and they're reacting to it. But more and more are going to get on board with what is going on. Believe me, you're not even hearing any of this being talked about in these crazy, wild websites like Zero Hedge or anything like that. They're going to catch on. Down the road, they're going to be talking about exactly what I'm telling you right now. All right? I see this before everybody. I know how everything's going to play out. Dollar's going down. Inflation's going to pick up. And it's all going to be kind of a self-sustaining effect. Because as the inflation picks up, what does the Fed do? Of course, in its mind, in the economic orthodoxy of how central banks treat things, they're going to think they need to raise interest rates more to squash that inflation. And that action will, in fact, exacerbate the inflation. They're going to drive it higher. Stocks will react more negatively. All right, people are not going to be able to understand this because they're going to see the inflation go up as the stock market grinds. Now, this is not going to be a crash. This is not going to be a repeat of 2008, 2009. This is not going to be 1987. I've heard people talk, trying to, make that comparison. That's not going to happen. This is going to be, as I have been saying for a long time, the 1970s, where stocks grind sideways to lower for a long period of time, restoring value in that way. It's going to be very frustrating for a lot of people. Not for my people, See, we're all going to make money because I know exactly how this plays out. And this is not a guess on my part, by the way. This is understanding the dynamics of what is going on here. This is absolutely not a guess. I see people, some article, oh, this is what's going to happen. Then I go there and there's a bunch of charts with lines this way and that way and ABC and ABCDE, and that's tea leaf reading. They don't know what they're talking about. But they put it up there as some kind of scientific analysis. My analysis is a rational and clear and concise understanding, bulletproof, of what is going to happen. Very simple. So that's what you get when you understand MMT, and when you are an applied MMT practitioner, which only I am and only my group is. There are MMT theorists out there, people who have, developed this school of economic thought, but they are not applied practitioners. They are theorists, they are academicians. I am the only applied practitioner of MMT, all right? And it's in my report, MMT Trader, and the people who follow me, they have that. Now that understanding and that knowledge and that skill combined with the proper mental game, and that's it. I mean, you crush everything. You crush everything. There's no competition. There's no comparison. So that's where it is, people. Just wanted to put that out there. So go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. And start to educate yourself, folks. Start to understand what is going on here. All right. Bye, everyone.